You refinanced your strategy for the last rate environment, and now that environment has already shifted again, which means half the financial advice you are still following is quietly working against you. The real problem is not that rates changed. It is that most people set their savings, debt, and investing strategy once and never revisit it as the rate environment moves, so they end up running an outdated playbook in a new game. Today, we are recalibrating all three: savings, debt, and investing, for exactly where rates stand right now in 2026. Welcome to Daily Money Mindset. Let us start with what has actually shifted. After the aggressive rate hikes of 2022 through 2023 and the gradual adjustments that followed, the 2026 rate environment sits in a meaningfully different place than either the near-zero rates of the early 2020s or the peak rates that followed. This matters enormously because nearly every financial decision you make, where to keep cash, how to handle debt, how to allocate investments, has an optimal answer that depends directly on where rates currently sit, and that optimal answer has moved. Let us start with savings, because this is where the most money sits doing the least optimized work. If your savings are sitting in a checking account or a traditional savings account earning a fraction of a percent, you are leaving real money on the table in the current rate environment. High-yield savings accounts and money market funds continue to offer significantly higher yields than traditional bank accounts, and the gap between what your money could be earning and what it is actually earning compounds meaningfully over time. The action here is straightforward. If you have not moved your emergency fund and short-term cash into a high-yield account in the last 12 months, that single move alone can be worth hundreds of dollars annually with zero added risk. Beyond the basic high-yield account move, the current rate environment makes certificates of deposit and Treasury bills genuinely worth considering for cash you will not need for 3 to 12 months. The strategic question is whether to lock in current rates or stay flexible for potential future moves. The honest answer depends on the specific trajectory the market is pricing in. If rate cuts are broadly expected over the coming year, locking in a CD or Treasury bill at current rates captures yield that may not be available later. If the path is uncertain, a short-term ladder, splitting funds across 3, 6, and 12-month maturities, gives you both yield capture and flexibility without betting everything on a single rate prediction. Now let us move to debt, where the calculus has shifted significantly depending on the type of debt you are carrying. For variable rate debt, credit cards, some private student loans, home equity lines of credit, the priority remains aggressive payoff regardless of the broader rate environment, because the rates on this type of debt remain elevated relative to almost any alternative use of that money. There is no rate environment where carrying high-interest variable debt while keeping cash in a lower-yielding account makes mathematical sense. For fixed-rate debt, particularly mortgages, the calculus is more nuanced and ties directly back to refinancing timing. If you locked in a mortgage rate during the higher rate period and current rates have moved meaningfully lower, running your refinance break-even math now is worth the 20 minutes it takes. If you locked in a historically low rate during the near-zero period, the math almost certainly still favors staying put rather than refinancing into a higher current rate, even if you have other reasons to consider it. Now, let us talk about investing, which is where the rate environment has the most layered and least understood effects. The most direct relationship is between rates and bond prices. When rates fall, existing bond prices generally rise. And when rates rise, existing bond prices generally fall. If you hold individual bonds or bond funds, understanding which direction the current environment is moving helps you understand why your bond allocation is behaving the way it is, and whether adjusting duration in your bond holdings makes sense for your specific situation. The less obvious effect is on equity valuations broadly. Higher rates generally make future corporate earnings worth less in today's dollars, which is part of why growth stocks and richly valued technology companies tend to be more sensitive to rate movements than value-oriented or dividend-paying companies. If the current environment involves elevated rates relative to the past decade, this is part of the reasoning behind a more balanced allocation between growth and value rather than a pure growth tilt, which worked exceptionally well during the near-zero rate decade but carries different risk characteristics now. Dividend-paying stocks and REITs deserve specific mention here because their relationship with rates is often misunderstood. These investments are frequently treated as bond substitutes by income-focused investors, which means they tend to face pressure when rates rise because actual bonds suddenly offer competitive yield without the equity risk. In the current 2026 environment, this means evaluating whether your income-focused investments are priced attractively relative to comparable bond yields, rather than assuming dividend stocks are automatically the right income vehicle regardless of the rate backdrop. For retirement accounts and long-term investing specifically, the practical takeaway is less about dramatic reallocation and more about rebalancing discipline, which we have covered in detail in a previous video. The current rate environment is a good prompt to check whether your bond allocation matches your intended risk level, given that bond behavior has been considerably more volatile in recent years than the multi-decade stretch before it. Let us bring this together into a practical action list for where things stand right now in 2026. First, audit where your cash is sitting and move anything earning near zero into a high-yield account or short-term treasury position. Second, attack any variable rate debt aggressively, regardless of what the broader rate environment is doing, because that math rarely changes. Third, run your mortgage refinance break-even calculation if you locked in during the elevated rate period, and leave it alone if you locked in during the near-zero period. Fourth, review your bond allocation and duration with an understanding of the current rate trajectory rather than the trajectory from several years ago. Fifth, reassess whether your equity allocation still reflects an appropriate balance between growth and value given current valuations and rate levels. None of this requires predicting exactly where rates go next, which is something even professional forecasters get wrong constantly. It requires understanding the mechanical relationships between rates and each part of your financial life clearly enough that you can adjust your strategy as the environment shifts, rather than running a strategy built for a rate environment that no longer exists. If this helped you think through your own financial setup more clearly, hit the like button and subscribe to Daily Money Mindset for 3 videos every week covering exactly this kind of practical current strategy. Drop a comment below and tell us which area, savings, debt, or investing, you think needs the most adjustment in your own situation right now. Resources and current rate tracking tools are linked in the description below.